Hello, my name is Maria Bezubova and you're at my channel Fertilizers Jazz. Here we talk about events, trends, technologies in the world of fertilizers and agriculture. Please subscribe to the channel, put like to this video, and let's jazz! Today is July 7 and this is a weekly markets update. Let's have a look at the news of week 27 and see what are the next trends. Urea market has calmed down last week following the de-escalation between Iran and Israel. However, fundamentally, price sentiment is staying firm amid tenders in India and Ethiopia, as well as buying interest that is expected to emerge from Latin America and Australia. Indian purchase tender will close today, and it is the largest suspense in the market, of course. Most likely, India will not be able to secure more than 1 million tons maximum. And taking into account comparatively low stocks of 6.5 million tons in June, and monsoon that arrived a bit earlier this year and seems to be healthy, more supply and quickly will be needed. Production figures are also relatively low to ensure supply during purchasing window needed. So, on July 3, Indian Minister of Chemicals and Fertilizers sent out a letter to all Indian urea producers, stating that producers need to take urgent steps to maximize production. And one of the measures should be no turnaround during this fiscal year. All this information supports rumors circulating that next purchase tender might happen somewhere in July. Supplies from Middle East and Russia will dominate this tender this week, as usually, but in order to secure amount close to 1 million tons, also other suppliers from Asia and possibly Nigeria need to join the game. So, let's see how it goes. Another factor supporting bullish sentiment continues to be Ethiopia, where EABC issued new purchase tender for 212,000 tons of urea to be supplied in 4 lots during July, first decade of August. The tender will close today as well. The previous tender resulted in purchases of Chinese material, but now it is unclear if all these nominations will be finalized with shipments, taking into account significant price surge. So, generally speaking, market agrees that July-August global supply is tightening more and more. So there is no chance that price will return to bearish anytime soon. Egypt and its export availability was a key talking point during last week. And finally, several small sales were conducted at the level of $455 to $60 FOB. That formed new benchmark. However, international market is nervous, expecting rather limited availability from Egypt in July and August, due to both domestic demand and potential gas supply curtailment for the industrial consumers. Currently, fertilizers producers' output doesn't exceed 70% capacity. So, let's see how the situation evolves in July, especially with the new LNG regasification facility that is expected to arrive. Dangote sold 3 cargoes for July last week in the high 420s. One of these cargoes might head to a non-traditional market, Ukraine, which has once already purchased Nigerian urea. But this deal still is pending confirmation. Elsewhere in Europe, the demand is almost muted. On July 1st, additional tariffs for Russian products came into force, and last week UK also announced additional tariffs for Russian and Belarusian products that will come into force as of July 18. UK will impose additional duty of 10% that will increase to 20% in a year from now and to 35% from July 1st, 2027. So it is a similar approach that was taken by EU. The only market that is looking for product now in the region is Turkey, which was hit by supply disruptions from Egypt and Iran. Last week's Egyptian sales are supposed to go to Turkey. Russian producers shipping from Baltics corrected their offers downwards, and new reset level will very much depend on the Indian tender result. During summer months, most of the producers will go into turnarounds, so in general, they should feel comfortable. Both European factories affected by drones attacks earlier in June came back on stream last week, so supply from the Black Sea also is back in usual volumes. In the Middle East, suppliers were getting ready for Indian tender, so there were no fresh spot sales last week. Iranian producers were actively offering significant volumes, but no actual deals followed sales tenders. Their target price level was set at $420 FOB, but there were no interest above $400. Turkey would be interested in Iranian volumes, of course, but price level needs to be comparable to the no-duty Egyptian product, meaning not higher than $390 FOB. In the Southeast Asia, levels as high as $470 FOB were reached last week. It was the highest price received by Brunei producer, while Indonesian pupuk highest sales happened at $461 FOB, following a tender closed at $452 FOB. These levels indicate that price of the Indian tender has to be around $470 CFR West Coast minimum to provoke interest from the regional producers. Chinese actual export volume is a bit of a puzzle, as there is no confirmed information available. At least I haven't seen it. There are different evaluations. Most of them agree that actual exports as of May are not higher than 1 million tons, while those including tons in the ports ready for exports are around 1.5 million. July export quotas of main producers are understood to be mostly finished. And there is still no clarity regarding an additional quota of 2 million tons that might be granted for the exporters for September-October. Last week, there were no fresh confirmed deals heard, but offers to the Brazilian market were quite aggressive, at the level high $430 CFR. Brazil will enter active purchasing mode very soon and definitely can be the main outlet for Chinese product. But for now, Brazilian buyers are cautious, watching situation with the Indian tender developing before taking any further decisions for massive purchases. Also, there were no fresh deals conducted into Argentina or Central American markets last week. In the US, liquidity returned to the market, resulting in barges prices increase by $20 versus previous week, to the level of $403 to $10 FOB per short ton. But, of course, traded volumes are rather thin due to off-season. Paper values ride on the roller coaster last couple of weeks. The market is very uncertain about future direction. Last week, all benchmarks showed significant upward correction, except Egypt FOB, which hovered more or less at the same level, with minor decline for all months. August and September were traded at the average around $450. Arab Gulf future price rebounded by $15 and $10 for August and September, respectively, to the average around $437 plus. NOLA values showed even higher upward correction, to the average of $403 per short ton for July, $413 for August, and $419 for September. Brazil CFR also corrected by almost $15 for each of these 3 months. Ammonium sulfate market price has retrieved from the panic highs of a week ago across geographies. Chinese standard AMSOL price dropped to 180s FOB level, with some bids heard even lower than that. Compacted product price decreased to $190 to $200 FOB as a result of shrinking demand from Brazil. Buyers there purchased significant volumes during panic related to escalation in the Middle East, and then stepped back from the market last week. In Southeast Asia, the demand is quite robust, specifically in Thailand and Philippines, but buyers are resisting high price level. CFR prices continue downward correction and were evaluated at $190 to $200 for Capro grade material last week. Other than that, markets are mostly in off-season mode, with activity subdued. Nitrates demand has slowed down as prices have become unaffordable for the vast majority of buyers, and it is off-season, of course. But despite this, European producers continued to raise prices. Last week, Yara raised price in the UK for July-August delivery by 40 pounds per ton. In Poland, domestic producers increased nitrate price by 15 euros, but only for a quarter of July volume. Now, July-August volumes seem to be largely committed, and producers feel comfortable for the rest of the summer. Market players are interested to see how the import tariffs influence Russian pricing and exports into Europe. although producers had started raising prices more than a month earlier. Planned maintenances of Russian producers will naturally decrease products flow in July-August. For Brazil, last week indications put CFR level at $340, and about 20,000 tons of Russian material likely have been sold at this level. But generally, the demand was limited last week. In the ammonium, market sentiment west of Suez was firm. European buyers were testing the waters for July shipments, but spot supply looks to be tight. For now, CFR duty-paid price level is evaluated in the range between $465 to $85, but sellers see 500 level as very achievable in August. East of Suez FOB prices remained largely unchanged, around $300. Immediate spot demand from India was met during past weeks, so Indian buyers stepped back from the market. There will be more demand for August shipment, but at that time Iranian producers are supposed to return to the export market, so unlikely that prices will surge. In the US, export FOB prices increased by $5 following firm sentiment of European market. Domestic demand there was almost subdued. The biggest news in phosphates market was settlement of contract between Bangladesh and OCP for the 25-26 fiscal year. The total amount agreed was 1.1 million tons, split into 630,000 tons of TSP and 480,000 tons of DAP. So, OCP continues pushing sales of TSP wherever possible. Now, market expects Bangladeshi government to issue its private sector tender to cover the rest of the need. Activity in India slowed down last week, however, prices continued moving up. After phosphoric acid contract was settled at an enormous $105 per ton increase in Q3 between CIL and JPMC, activity has become muted. Meanwhile, a Russian DAP cargo of 30,000 tons was sold at around $795 CFR India. But next offers have been heard even higher, at almost $800 CFR. Market players indicate that they would not be surprised to see prices higher this psychological threshold, as India is in need of product. Now India is gearing up for Rabi season, and Kharif is essentially done. In order for cargoes to make it to India for Rabi, purchasing activity would need to take place over the next couple of weeks. Regarding Indian tenders outcomes, NFL received one offer for 50,000 tons of DAP in the tender that closed on July 1, and issued another tender for 25 to 50,000 tons that will close today, both for shipment by the end of July. Hurl pushed its tender closure also to today, so this week the results will be clear. In any case, new supplies unlikely will be lower than an $800 CFR. Ethiopian EABC also supports global bullish trend with a tender for another 70,000 tons of DAP with offers due by today. There are rumors circulating that previous offers might not be finalized with the shipments due to international price increase, same as with Urea, but this is unconfirmed. Prices out of China continue climbing amid this robust demand. Last week, DAP price was already around $760 FOB and higher. DAP export price floor was increased to $730, which is $50 more versus May level. Last week, activity in Brazilian market was limited, and farmers are more and more concerned with affordability. MAP price level was evaluated at $755 to $65 CFR. US NOLA prices were also unchanged, with market activity mostly muted due to holiday week. Moving to the fundamentals. European natural gas futures fluctuated at the same level versus a week ago, around 33.5 euros per megawatt hour. While the recent European heat wave is expected to ease, reducing cooling demand, higher wind power output in Northwest Europe could further curb gas use by power plants. Supply remains stable, with consistent Norwegian exports and LNG send-downs. Additionally, sluggish LNG demand from China, due to its slowing economy and increased US tariffs, has diverted more gas to Europe, increasing supply and weighing on prices. US natural gas futures fell below $3.4 per MMBtu after Energy Information Agency data showed the 11th straight week of above-average storage injections. Energy firms added 55 billion cubic feet to storage last week, exceeding expectations, and well above the 35 billion added a year ago. So the trend reflects robust supply. Meanwhile, hotter mid-July forecasts are expected to drive up air conditioning demand and gas-fired power usage. LNG export activity is also picking up as plants are gradually returning from spring maintenance. Golden Pass LNG requested US approval to re-export LNG starting October 1, signaling that the facility is close to start up. Agricultural commodities future prices rebounded after a significant drop of previous week. Wheat futures, after a dip a week ago, rebounded to $5.6 per bushel, boosted by short covering. The situation with supply is very different across the globe. Sizable crops are expected in Europe and the Black Sea region, despite recent harsh weather. Meantime, in Brazil, heavy rains and frosts delayed planting, with only 57% of intended wheat acreage sown by June 21, raising concerns about yield and area. US wheat export inspections fell 30% year-over-year, reflecting limited availability. Severe drought in China's key wheat-producing regions may cut output by 5 to 15%, potentially boosting import demand. With US wheat stocks down 20% from last year, even average Northern Hemisphere harvests may not ease global supply concerns. Corn futures also climbed above $4.3 per bushel, recovering from 6 months lows at the end of June, as mounting evidence of tightening supplies converged with resilient demand. In its June 30 acreage report, the USDA trimmed its estimate for US corn plantings to just below the consensus. And sweltering early summer heat across the Midwest has raised fears of yield losses during the critical pollination window, even though crop condition ratings remain elevated. On the global front, export demand has surged, particularly from Mexico, where the abrupt suspension of a 25% US tariff has restored American corn's competitiveness. Also, Brazil's slower-than-usual second crop harvest has limited alternative supplies. In the US, strong domestic ethanol blending ahead of peak summer driving season continues to underpin consumption, collectively reinforcing the recent rally in corn prices. Soybean futures climbed above $10.5 per bushel, supported by short covering and pre-holiday positioning ahead of the US Independence Day break. However, gains faded late in this session as favorable US crop weather and abundant global supplies tempered bullish sentiment. Expectations for a strong US harvest and a bumper crop in Brazil continued to cap upside potential. Forecasts for warm temperatures and scattered showers across the Midwest were seen as beneficial for crop development during the crucial flowering and pod setting stages, conversely than for corn. Still, unconfirmed speculation that President Trump may announce progress in US-China trade talks helped lift sentiment. Moving to the shipping industry. Containerized trade index dropped again, losing more than 100 points last week. The reason is the same: low demand from the US for Chinese cargoes. Freight rates from China to US dropped by 10 to 15% more, depending on the cost. Freight rates from China to Europe also decreased by 9%. Market analysts believe that there will be more downward correction in the second half of 2025. The situation will depend on finalization of global tariffs agreement. The Baltic Exchange Dry Index continued its decline and lost another 55 points. The Capesize market showed signs of stabilization last week, following a period of softness, with improvements in the Pacific Basin and a more balanced Atlantic. The Panamax market activity was mostly flat last week, with the exception being east coast of South America, which witnessed a steady rise from midweek with solid levels of demand and firm fundamentals. For ultra-supermax sector, it was a rather positive week, as demand increased in some key areas like US Gulf and Asian arena. And on the contrary, for the handysize sector, the week was generally quiet. Activity continued to slow down across the continent and the Mediterranean, as many participants were away attending various shipping events. To sum up, markets cooled down after a panic mode of last weeks across segments. Urea market is eagerly waiting the results of the Indian tender this week, as well as tender of Ethiopian EABC that will give the direction to the market for the rest of the summer. But it is clear that supply will be tightening, so market sentiment will remain rather bullish. Chinese exports will be a significant factor, of course, but we still need to wait until additional export quota confirmation, if it happens. Ammonium sulfate market price corrected downwards following the trend of urea and due to paused demand from Brazil, which stepped away to wait and see new price levels after Indian tender. On the contrary, European nitrates prices continued increasing despite affordability issues. Meanwhile, phosphates price trend was a good old story. Global prices continued climbing last week. Fresh sales to India touched psychological threshold of $800,000 CFR and looks like will not retrieve from this level anytime soon. Gas price in Europe fixated at the same level as a week ago, and market fundamentals suggest no reasons for upward correction soon. US gas price dropped, however, might again go up later in July amid high temperatures and growing LNG flows. Agricultural commodities future prices rebounded from the lows of a week ago for all key crops due to re-evaluation of harvest prospects in the key producing countries. Container shipping activity decreased more as a result of further demand reduction from China to the US. Bulk shipping activity also slowed down a bit, mainly due to decrease in handy-size segment. So, let's see what is next around the corner. But it will be already next week. Thank you for watching. Please subscribe to the channel, put like to this video, push the bell in order not to miss any updates, and see you soon.